What's up, YouTube? It's Todd Horst here with another video for tastytracker.com. Today's topic is Vega Overstated, and don't worry if you don't know what that means. I'll be starting from the very beginning and working the whole way up to more complicated thoughts, and hopefully everybody will learn something new, or at least have something to think about and discuss in the comments below. If you could give me a thumbs up on the video, that would really help out. So let's get right into it today. What is Vega? Vega is the Greek for volatility. So you can remember very easily V for Vega, V for volatility. And what are Greeks? Well, very simply put, Greeks are the pieces of the puzzle that dictate the value of an option. So different pieces might be weighted differently, especially on the time, how close they are to expiration. And that's a whole nother series of videos, but I do have a tool on my website which allows you to enter in the different aspects, the different Greeks, and it will spit out what the values are and some other neat information if you're into geeking out on that kind of stuff. That's also known as the Black-Scholes formula, so you can use my calculator or you can just do some Googling on Black-Scholes and learn more about that. So why is volatility important? Well, the more volatility there is in the market, the greater chances are a deep out of the money option will become in the money. So what does that mean? That means I could buy an option super cheap potentially, and if the market is making wild swings all over the place, that option that I paid, we'll say $10 for, could go 10x, and I could make $100. That's obviously the basis of some of the forums, or like Wall Street Bets on Reddit, is to buy deep out of the money, which simply means cheap or low probability option strikes, and with the hopes that they'll become in the money, which means they're either higher or lower, depending on whether it's a call or a put, respectively, than the stock is trading at currently. So, moving on, if we think about the chances, if the chances are greater to get profit, then we're going to need to pay more for that chance. So if I buy a $300 call on Apple, hoping that it goes up past 300, but it's currently only trading at $100, and it's been at the $100 range for the past 5 years, say, there's zero chance that it's going up to $300 in the next month. So that $300 option, I'm going to have to pay very little for. Now, another scenario is Apple is trading at $100, but it's been swinging wildly between $50 and $300, but currently it's at $100. Since it's swinging wildly, that $300 call is now possible. It's potential that in the next month, Apple will go up to $300. So even though it has relatively little value at the moment, the chance of it coming into profitability is greater because it's making more wild swings. So I'm going to pay a little bit more for that chance. You see the difference between those two scenarios. So if an option buyer pays more for that chance to be successful, then the option seller would mean that they would receive more for that. So put simply, an option seller prefers high volatility because they can get higher premium. Let's see if I can move my mouse. There we go. Okay. And that all makes sense because as a seller, there is an increased risk there associated that position that I sold to somebody could go against me. So I'm going to want to be compensated more Otherwise, why would I choose a volatile stock when I could just choose a non-volatile stock that isn't going to go against me if those were priced the same? I hope that's making sense. Obviously, if it doesn't, leave a comment below. But moving on. Vega is naturally overstated. So if we look to the future, how much uncertainty is there? Infinite amount of uncertainty, because we don't know what's going to happen tomorrow, especially with the situation we're in right now. It could go anywhere. Stocks could completely rebound from their lows. They could go back and retest their lows. We could stay in this range for another year, or it could be 1 month. Nobody knows. Because of that uncertainty, there's more volatility and more premium now to buy puts or to buy calls. Now, if we look at the past, how much uncertainty that we thought there was going to be actually played out? Some, of course. You have the beginning of 2019 when there was a huge dip and then it recovered immediately. There's certainly things, something or multiple things each year that throw a wrench in things. Nothing is completely chugging along solid and predictable all the time. But there's always less uncertainty that played out, that actually happened, came to fruition, than what people anticipated. People are always calling the end of the market. There's going to be a crash. This year's the year. And obviously them calling that every year and it only happening once every decade or whatever means that there are 9 years where there's more expected volatility than actual volatility. Okay. And you can see this. You spend time looking at the market. There's a huge amount of time. Stocks are going nowhere. They're doing nothing. They're moving extremely slow. And anytime they try to go outside of their range, there's multiple validations. Think about that for a second. The stock is going up. It will continually hit the same area, bouncing back down against that resistance until it finally breaks through. And then, yes, sometimes there will be a breakout, but other times it might just break out into the next range, maybe $10 range, depending on the size stock, obviously. But it will break out into the next range, and then it will sit in that range for a while. So you've seen it time and time again where people are expecting big moves. Maybe it's from earnings or whatever, and 99% of the time, earnings will have a huge spike or a drop, but then what happens within 3 months? Things tend to level back to where they were. So if you wanted to sum it up, you could say the future is filled with emotions, specifically greed and fear. But looking back over any given year, it's much more muted than that. People thought things were going to happen one way or another, and that never pans out. So your next question is, well, who am I? Go ahead and prove it. You don't know anything kind of attitude. And I can't, at least I won't. I could devote many, many, many hours, and I'm only one person with a limited number of resources. But if you're not going to be lazy, you could do some Googling and definitely see how much research is out there that backs this thinking up. Tastyworks, I'll definitely put these two links in the description, but these are two good, one's an article, I think, and one's a video. Tastyworks has been sort of on the forefront of option sellers. They've been doing it for quite some time, and they've already done the legwork. So even if I wanted to do it, it would be just me reinventing the wheel. There's been plenty of studies, like I said, from Tastyworks and other people to back up what I'm saying. So yeah, I'll provide those links. But you can just Google actual volatility versus implied volatility or expected volatility, and you should come up with a bunch of articles. But all of this really is just backing up using statistics what is logical anyway. You can think about what I'm saying and and it's very, very clear that it makes sense. So let's go on to the next slide. Who cares? Why is this even a topic worth making a video about? Well, if we know there's an inconsistency in the market, that's something you want to exploit naturally. Duh. It can give you an edge. Why not leverage that and magnify that inconsistency in order to make profit? So this is just one advantage that you can use of several that I use in order to bring my probabilities of success up. So just a real quick example here. If you buy a 70% in the money spread, with in reality, if you trade hundreds of those, the data shows that you might get a 65% success rate. So you're actually going to get less because you bought it. And part of that is because of the volatility. Now, conversely, if we use if we sell a spread 70% out of the money success, it's going to be successful 75% of the time. Now, if you can make the same basically trade, it's just a difference between buying or selling, why would you choose something that's actually overstating its success rate? And maybe you don't believe in the statistics, but they're usually not debated. They're put on by all the brokers. They all have the same numbers and calculations to generate these. So it's not like it's something one person is saying, oh, this has a 75% chance of success. I do still believe that you need to use your own logic and understanding of the market to increase your odds. But again, that's just another part of my strategy. So this is the first part in a super small series that I'm going to do on sort of the edges that I use to help increase my success rate. And I'll go through and try to explain why we trade this way as primarily option sellers. So that's really it for today. I hope you enjoyed the video and maybe it'll make you think about something again that you haven't thought about for a while. If you could, again, give me a like and a comment below. My website is tastytracker.com, and as always, I'm not a financial advisor. Thank you guys, and I will talk to you next time.